Hey everyone, welcome back to Corporate Decoder, the place where we break down the complex world of business and finance into plain English to give you the edge. Today we're diving into a company that has been in the news for a big merger. Get ready because we're pulling back the curtain on some fascinating updates before we dive in. If you love getting clear, actionable insights from company filings, make sure you're subscribed and hit that notification bell. And hey, we've got a growing community on Discord chatting about all things corporate. The link is in the description below, so come say hi. Alright, let's get into it. Hillenbrand, a company that makes industrial products, is in the middle of a big deal to be acquired by Lone Star, a private equity firm. Now, mergers like this can sometimes lead to a bit of legal back and forth, and that seems to be the case here. Some shareholders have filed lawsuits saying that the company's information shared before the deal wasn't quite right or was missing important details. Hillenbrand says these claims aren't valid, but to avoid any delays or extra costs with the merger, they're voluntarily sharing some extra information. Just to be extra clear, so what is this new information about? It sheds more light on the background of the deal. Back in August, Hillenbrand received a handful of proposals from different companies interested in buying them. Lone Star, the eventual buyer, initially offered $34 per share. Other bidders offered prices ranging from $23 up to $32.5 per share. This gives us a clearer picture of the competitive landscape at the time. Later on in September, Lone Star came back with a more formal offer. This time the price was $31 per share. They explained that the drop in price from their initial offer was because of new information they found during their deep dive into Hillenbrand's business. Interestingly, this proposal also mentioned a plan for an incentive equity plan for management. This suggests they were thinking about keeping key people on board and motivated. Now, let's talk about how Hillenbrand's financial advisors valued the company. They used a method called a discounted cash flow analysis. In simple terms, they looked at how much cash Hillenbrand was expected to make in the future and then figured out what that future money is worth today. They used a discount rate, kind of like an interest rate, to bring those future earnings back to the present. This analysis suggested a range of values per share somewhere between $28.55 and $53.2. The merger price is $32 per share. So this analysis shows that the deal price falls within their estimated value range. Another way to value the company was by looking at similar publicly traded companies. They examined companies in the process equipment industry and companies with similar financial characteristics. They looked at something called TEV, which is like the total value of a company, and compared it to their earnings before interest, taxes, depreciation, and amortization, or EBITDA for short. For the process equipment companies, the multiples range from 6.6 to 15.0. For companies with similar financial traits, the range was 7.2 to 11.7. By applying these multiples to Hillenbrand's own projected earnings, they came up with an implied share value between $25.85 and $42.15. Again, this shows the $32 deal price is within this evaluated range. They also looked at past mergers and acquisitions in the industrial capital goods world. This helps them see what buyers have paid for similar companies in the past. They analyzed deals going back to 2012. The multiples for these past deals looking at enterprise value to last 12 months adjusted EBITDA range from a low of 5.7 to a high of 16.9. When they applied a relevant range of these multiples to Hillenbrand's projected earnings, they estimated a share value between $29.1 and $39. This analysis too puts the $32 merger price in the middle of the pack. It is good that multiple valuation methods are pointing to a similar ballpark, even if some suggest there might be more value on the table. Then there is this interesting analysis looking at the present value of a future share price. Essentially, they estimated what Hillenbrand's stock price might be in the future, say in 2027, and then discounted that back to today. They used a range of multiples and projected earnings for that future year. This gave them an implied future share price range, which after discounting, came out to be between $33.35 and $46.95. This particular analysis suggests that the $32 deal price might be on the lower end of what the stock could be worth in the future. Let's look at the actual projected numbers that form the basis for these valuations. The company is projecting significant growth in net revenue, climbing from $425 million in 2026 to $262 million by 2030. Their adjusted EBITDA, a key measure of profitability, is also expected to see strong growth, jumping from $391 million in 2026 to a hefty $689 million in 2030. That is almost doubling their earnings in just a few years, which is quite ambitious. The adjusted EBITDA margin, which shows how much profit they make for every dollar of revenue, is projected to increase from 16.1% to over 21%. This means they're not just growing revenue, but also becoming more efficient and profitable as they grow. Unlevered free cash flow, which is the cash a business generates after accounting for operating expenses and taxes, is also projected to nearly double from $230 million to $443 million over the same period. These look like solid growth projections on paper. Now, it's crucial to remember these are forward-looking statements. They are based on assumptions that the company believes are reasonable, but they are inherently subject to a wide range of risks and uncertainties. Things like global economic changes, competition, and even unexpected business disruptions could cause actual results to differ significantly from these projections. The company itself lists a ton of potential risks that could affect future performance, from market volatility and supply chain issues to cybersecurity threats and labor challenges. It's a long list, and it is important for investors to consider these potential headwinds. So, what is the verdict on Hillenbrand? On one hand, the company is projecting impressive growth in revenue, profitability, and free cash flow. The deal price of $32 per S-share falls within the ranges suggested by most of the financial analyses performed, though some analyses do suggest a potentially higher value. The added disclosures seem aimed at clarifying background information and providing a bit more detail on how the valuations were reached. The risks flagged by the company are pretty standard for a company in this sector, but the sheer number of them highlights the dynamic environment they operate in. The key question for shareholders will be whether this $32 deal price fully reflects the company's future prospects, especially given the strong growth projections. It appears the company is trying to move past the shareholder lawsuits by providing more context, and hopefully this clears the path for the merger to proceed smoothly. Alright, that is our breakdown of Hillenbrand's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think the $32 deal price is fair? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.